Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, Friday, February 6th, 2026. Microchip technology, ticker MCHP. We closed the session at $76.01, down 2.6%. But, if you just look at that red number, you're missing the real story. The story is in the volume. We saw over 20.2 million shares change hands just on Friday. That is nearly double the 90-day average of about 9 million. This was a massive liquidity event, a real changing of the guard. And it's happening right after our fiscal Q3 earnings beat that actually exceeded management's own guidance. And yet the market's response was this classic knee-jerk sell the news reaction. It pushed the stock right down to test a very critical double bottom pattern, somewhere around that $73 to $74 level. To me, that volume spike, it suggests capitulation. The weak hands are out and the strong ones are accumulating.
See, I wouldn't call it capitulation, and I certainly wouldn't call it a mistake. I see why you want to frame it that way. It sounds optimistic, but I just see it as a harsh reality check. You have to pull the lens back a bit. This stock had already rallied 85% from its 52-week low. 85%. That was a huge run-up based on hope. The market isn't blindly selling here. It's finally waking up to the fact that this company has a really fragile balance sheet that just doesn't justify this valuation. When you look under the hood of that earnings report, beyond the headline beat, the structural problems they're glaring. That 20 million share volume wasn't accumulation. That was investors rushing for the exits.
Well, I think that's a pretty premature dismissal of what is effectively a textbook turnaround in a very cyclical industry. My thesis here is it's straightforward. MCHP is successfully executing its 9-point recovery plan. We're not just hoping for a turn. We are seeing it in the data. Margins are expanding sequentially. We're seeing a massive cyclical upswing in bookings, and we have a management team that has navigated the absolute bottom of the cycle. They are now pivoting to growth. The price action we're seeing is consolidation before the next leg up. It's driven by fundamental improvements.
You keep mentioning this 9-point recovery plan like it's some kind of magic wand. But let's actually talk about what that means, because it's not just a PowerPoint slide. It's painful cost-cutting, it's closing capacity, it's freezing development. You're trading at 37 times forward PE for a company that is, right now, sporting an interest coverage ratio of less than 1. That is a dangerous, dangerous leverage profile for a company that's priced for perfection. You combine that with, frankly, uninspiring returns on capital compared to its peers, and I'd argue that Friday's sell-off wasn't consolidation. It was a rejection of the bull case right at that $80 resistance level. The market looked at the debt, looked at the price, and said, no thanks.
Okay, let's get into the weeds then. Let's look at the actual data from the Q3 fiscal 2026 report, because I believe it completely validates the turnaround story. Net sales hit $1.186 billion. That's a 15.6% increase year over year. That beat the consensus. But more importantly, look at the operational discipline. Non-GAAP gross margins expanded sequentially from 57.3% to 60.5%.
It tells me they're good at massaging the non-GAAP numbers to hide the pain.
No, in a hardware business, that kind of margin expansion over 300 basis points during the early stages of a recovery is the golden signal. It tells you pricing power is intact. They aren't slashing prices to move units. They're maintaining value. And the forward-looking indicators are even better. The book-to-bill ratio was well above 1 in December. CEO Steve Sanghi explicitly said that preliminary booking momentum in January was, and I quote, extremely strong. Now, you know the seasonality here. January is usually a hangover month. It's slow. Yet they're seeing acceleration. That signals the end of the inventory correction and the beginning of a multi-year upcycle. The 9-point plan is doing exactly what it was designed to do.
I'm sorry, I just don't buy that the recovery is as clean as you're suggesting. You're focusing on the non-GAAP fantasy, but let's look at the GAAP reality. The numbers that actually follow accounting standards. The GAAP net margin for the quarter was negative 4.39%. Negative. And why? Because of massive capacity underutilization charges, specifically $51.7 million worth.
Which is part of the plan to...
It's $51 million of waste. They are paying tens of millions of dollars just to keep factories idle, paying to heat and light empty rooms. You cannot just ignore that when you are carrying $5.37 billion in debt. That disconnect between the adjusted profit you love and the actual GAAP loss is exactly why the stock couldn't break that $80 resistance. The fundamentals are still messy. You're celebrating a recovery while the factory floor is costing them a fortune to do nothing.
But that is exactly my point about the plan. Taking those charges now is the discipline. They aren't flooding the channel with unwanted chips just to keep the factories running, because that would destroy pricing power later on. They're biting the bullet. That $51.7 million charge is the sound of responsible management. And that brings us to valuation, because I know you think it's expensive at 37 times forward earnings, but you have to price a cyclical company on normalized earnings, not trough earnings. If you price a chip company on bottom of the cycle numbers, you will never buy it.
Even on normalized metrics, the valuation is stretched. I mean, let's benchmark this properly. Microchip has a market cap around, $41.5 billion? If you compare them to the industry giants, Texas Instruments, Analog Devices, the disparity in quality is just stark. MCHP is trading at a premium price-to-sales ratio compared to NXP Semiconductors. And NXP is a very similar business, right? Automotive-heavy, industrial-heavy. Yet Microchip has a return on invested capital, an ROIC, of only 11.3%. The top-tier players in this industry, the ones you want to own, like Texas Instruments, are generating ROIC north of 35, even 40%. So why should an investor pay a premium multiple for subpar capital returns? You're paying a Mercedes price for a Honda engine.
Total System Solution Strategy, the TSS. Unlike peers who might just sell a commodity chip that you can swap out for a cheaper one next week, Microchip locks its customers in. They provide the connectivity, the power management, the security, and crucially, the proprietary development tools like MPLAB X.
Does a development tool really justify a 37 times forward PE? It's software.
Absolutely, because it creates massive switching costs. I mean, think about it from an engineer's perspective. You spent 6 months learning MPLAB X. You design your whole product using their libraries, their ecosystem. Moving to Texas Instruments isn't just swapping a chip. It's a complete redesign of the software stack. It means retraining your entire engineering team. That stickiness is why Microchip has historically maintained superior pricing power and gross margins averaging 57.6% over the last 2 years, even in a down cycle. You pay a premium for that stability. It's the same reason people pay a premium for Apple. Once you're in the ecosystem, you don't leave.
I would argue that stability is threatened when the balance sheet is this levered. Let's drill down into the financial health, because this is where the whole debt trap idea really takes hold for me. As of December 31st, 2025, the interest coverage ratio is sitting between 0.6 and 0.7.
That is a temporary trough metric.
It is a flashing red light. Let's be very clear about what that number means. An interest coverage below 1.0 means their current EBIT, their operating profit, is not sufficient to cover their interest payments. Think about that. It's like a household where your salary doesn't cover the mortgage interest, so you have to put the mortgage payment on a credit card. They are effectively borrowing or using cash just to service the debt. The net debt to EBITDA ratio is 4.18 times. That is way above their historical targets, and frankly, way above what's comfortable for a cyclical company. If the economy softens even slightly, if this soft landing becomes a hard landing, that leverage becomes an anchor.
I see why you think that. And look, I'll acknowledge the leverage is higher than we'd like, but you have to contextualize it within the cash flow. This isn't a company that's burning cash. In the December quarter alone, operating cash flow was $341.4 million. That is more than enough to cover the obligations and keep the lights on. Furthermore, management is fully aware of this. CEO Steve Sanghi admitted they are spooked by how difficult this last cycle was, and they have explicitly said they are prioritizing debt reduction over share buybacks. That's the responsible adult move to de-risk the company. They are not ignoring the debt, they're actively attacking it.
Being spooked isn't a strategy. It's a reaction to being over-leveraged. And look at the consequence of that fear. Prioritizing debt reduction means there's no floor under the stock price from buybacks.
That removes a key pillar of support that a company like Texas Instruments enjoys. If the stock drops, TXN buys it back. If MCHP drops, well, they can't do anything because every spare dollar has to go to the bank. But let's look at this growth story you mentioned. You think the bookings are the savior?
I do. The catalysts are real and they're immediate. Look at the auto sector. They just secured a major partnership with Hyundai Motor Group to use their 10-base T1S single-pair Ethernet solutions.
Okay, that's a lot of technical acronyms. Why does that matter to the bottom line?
It matters because it transforms the physics of the car. This isn't just selling chips for electric windows. This 10-base T1S allows Hyundai to replace heavy, expensive copper wiring harnesses with a single pair of wires. It makes the car lighter, cheaper to manufacture, and it increases the range of their EVs. This is the backbone of the software-defined vehicle. They are becoming indispensable to the architecture of the modern car. That is a secular growth trend that transcends any economic cycle.
But automotive is softening globally. We're seeing EV demand start to plateau.
True, but the content per vehicle is increasing. So even if they sell fewer cars, Microchip sells more silicon per car. And it's not just cars. Look at the data center. They just announced 3 new design wins for their 3-nanometer PCIe Gen 6 switches. Again, to translate that, these are the traffic cops for data inside an AI server. You can have the fastest GPU in the world, but if the switch can't handle the data flow, you have a bottleneck. These are specifically for AI infrastructure. One of those wins alone is projected to bring in $100 million in revenue in calendar year 2027. They're pivoting the portfolio to where the growth is.
That is a compelling argument, but have you looked at the timeline? You just said calendar year 2027. We are sitting in early February 2026. Investors have to survive the next 12 months before they see a dime of that AI revenue. And right now, what they are seeing is inventory. Microchip is sitting on 201 days of inventory. That's over $1 billion worth of chips sitting in warehouses gathering dust.
Management has stated that is long lifecycle inventory. These aren't consumer gadgets that go obsolete in 6 months. They're industrial chips that will be sold for 10 years.
In the semiconductor world, long life is relative. In a fast-moving sector, holding 201 days of stock is a massive risk. If demand patterns shift, and they do, rapidly, or if a competitor releases a more efficient chip, that inventory becomes a liability. We could be looking at future write-downs, which would further crush that gap profitability I mentioned. You're betting on a perfect recovery to clear that glut. I'm saying the risk of obsolescence is just priced too low. You have a mountain of chips and a mountain of debt. That is a tough place to start a rally from.
Well, I think the smart money disagrees with you on that risk profile. If you look at institutional flows, the confidence is undeniable. Institutional ownership is hovering around 96%. But look specifically at Tudor Investment Corp. In the late 2025 reporting cycle, they added over 51 million shares. That is a massive, high-conviction bullish signal from a top-tier fund. They're looking at that 85% rally and deciding it's just the beginning. They are positioning for the cycle turn. They see the 9-point plan is working, and they're voting with their wallet.
I'm glad you brought that up because there's a glaring divergence there. You have Tudor buying, sure, but look at the people who actually run the company. Look at the insiders. Look at Steve Sanghi.
Insider selling happens for many reasons: diversification, tax planning.
No, stop. This is systematic. Steve Sanghi isn't just a CEO. He is the architect of this company. He's a legend. He knows this business better than anyone on Wall Street. And what is he doing? He sold nearly $1.5 million worth of stock recently. He adopted a 10b5-1 selling plan back in June of 2025. The CFO, James Eric Bjornholt, is selling. Director Matthew Chapman is selling. In the last 90 days, insiders sold over $9 million worth of stock, and there was zero open market purchases by top executives. Zero. If the 9-point recovery plan is guaranteed to double the stock price, why are the people who wrote the plan selling into the rally? If the recovery is so strong, why aren't the executives buying? That is the question investors need to ask themselves.
That's an interesting point, though I would frame it differently. These executives are heavily compensated in stock, so selling a portion after an 85% rally is just rational portfolio management, not a vote of no confidence. It's estate planning. The signal from Tudor, putting fresh capital at risk to the tune of 51 million shares, carries more weight for the future stock performance than executives diversifying their personal net worth. Hedge funds are in the business of making money on stock appreciation. Executives are in the business of running the company.
Well, I suppose we'll see who's right. But when I see the CFO selling while the interest coverage is below 1, it makes me nervous. It just feels like they're securing their own lifeboats while telling the passengers the ship is unsinkable.
Let's just pivot back to the technicals for a second, because you mentioned the double bottom at 73 to 74. The fact that the stock held this level on Friday despite that sell-off, it suggests significant support. The market is absorbing that 20 million share volume spike. The sellers came in, they dumped their shares, and the buyers stepped up at 76.
Holding it for one day is one thing, but the failure to break $80 is the real story here. We are stuck in a range, and until they can prove they can cover their debt payments with operating profit without relying on depreciation add-backs, I think that ceiling is hard. That $80 level is going to be a brick wall as long as the debt metrics look this ugly.
And I believe that ceiling is about to be shattered by the operational reality. We have the guidance for the March quarter, sales up 29.8% year over year. That is explosive growth. You cannot call a company growing at nearly 30% a value trap.
It's easy to have explosive growth when the year-over-year comparison is against the bottom of a trough. That's just math, not magic.
Growth is growth, and margins are guiding up to 61.5%. They are clawing their way back to their long-term model. They are executing the turnaround right in front of our eyes.
Okay, let's summarize where we stand then, because the risks here feel asymmetric to me. While MCHP is, undoubtedly a critical company, the stock right now is an expensive gamble. You have high leverage, 4.18 times EBITDA, combined with consistent insider selling from the very people who should be most bullish. And the fact that the interest coverage is below 1.0 is a fundamental red flag that suggests that double bottom might fail. Caution is required until that balance sheet health improves. The clock is ticking on that debt.
And I remain convinced that semiconductor investing requires looking forward, not backward, at the scars of the last cycle. The 9-point recovery plan is objectively working. Margins are recovering to over 60%, and that January booking surge confirms the cycle has turned. The pullback to $76 is an opportunity to buy a high-quality franchise right alongside Tudor Investment Corp. The debt is manageable, the cash flow is strong, and the strategic wins in auto and AI provide the runway for the next leg up. The train is leaving the station.
We'll see if that train can get up the hill with all that debt in the cargo hold. The next quarter is going to be the truth teller. If they can't convert that backlog into real GAAP profitability, that debt is going to weigh very, very heavy.
On that, we can agree. It all comes down to execution. Thank you for listening to the debate.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.